Hello everyone, today we're going to discuss the moratorium extension and its impact on banking and NBFC sector. Moratorium extension by RBI does provide relief to the borrowers but is negative for financiers who are already staring at high NPAs. It is severely negative for low duration products like microfinance, credit card, commercial vehicle loans, etc. This moratorium is like a double whammy for the financiers as it increases the overdue amount and depletes the asset value. This, along with borrowers' falling income generating opportunity, could be a perfect combination for loan default. RBI extended the moratorium on term loans installment by another 3 months, that is from 1st June to 31st August. Banking and financial services stocks, which have seen deep cut in the last 2 to 3 months on rising NPA risk arising from COVID-19 disruptions, were further pulled down as investors were becoming jittery on borrowers' uncertain behavior once moratorium period ends. Moratorium extension does provide relief to home and auto buyers, real estate sector, and small corporate finance facing working capital issues, but is negative for financiers who are already staring at high NPAs. In our view, moratorium extension is severely negative for low duration products like microfinance, credit card, commercial vehicle loans, etc. As per management commentaries during earnings call, moratorium opted by MFI, CV and auto loans have been very high in the range of 70 to 80% of loans. Moratorium extension double whammy for the lenders. It is like a double whammy for the financiers. 6 months moratorium will increase the financial burden on borrowers, especially microfinance borrowers where interest rate was very high. On the other hand, this long moratorium period could be enough for the depletion of asset value of some of the asset financing NBFCs. In terms of segment, microfinance institutions is more vulnerable with the moratorium extension as it could destroy the credit culture and hence would be negative for Bandhan Bank or small finance banks like Ujjivan or Equitas or any other NBFC microfinance institutions. The next vulnerable segment could be unsecured credit card and personal loans if the moratorium by value increases. Large private banks like HDFC, ICICI and Axis Bank do have exposure to this unsecured segment, but this exposure as a percentage of overall loan book is small. On the other hand, they also have large exposure to the existing customer having liability relationships like salary account or current account with the bank. Several of these banks have also indicated that the repayment history within moratorium customers is encouraging and hence we assign low probability of loss given default on large part of their exposure to these moratorium customers. Expect one deep restructuring for working capital borrowers. On the other hand, deferment of interest on working capital facilities for another 3 months and converting the accumulated interest over the deferment period into a funded interest term loan which has to be repaid by the end of the current fiscal year is only a stopgap arrangement and not an effective measure in our view. This would ease the one-time interest payment criteria set previously. However, the burden of interest on FITL would increase the overall financial burden further at a time when business activity would take time to come back to normalcy. Hence, the only solution to this could have been a one-time deep restructuring. We might see this announcement in near future. Financial sector, tough operating environment. Banking sector is facing two major issues on its revenue growth: weak loan growth and margin pressure. Loan growth is hovering in the range of 6 to 7%, while NIM is under pressure as falling rate environment is always negative for lending institutions as loan repricing happens faster than the liability repricing. On the other hand, risk to collections and credit culture has been deteriorating, which could increase the provisioning requirements for the banks. There is higher NPA risk on portfolios like MFI, commercial vehicles, construction equipments, small businesses, credit card personal loans, etc. As a result, profitability of sector would see a major beating during fiscal year 21 and is likely to rebound in fiscal year 22 or early in the fiscal year 23. Return ratios are likely to come to healthy levels only in fiscal year 23, and as a result, we expect stronger players with strong capital adequacy will benefit and gain market share. Many of these names having strong liability franchise and well-diversified asset book have already seen deep cut in their share prices by 30 to 50% since February 2020. Several of these names are not only trading below its 10-year average valuations but also below the minimum valuation seen during the Great Financial Crisis of 2008. As we think these negatives are already in the price, we can accumulate the quality names like HDFC Bank, ICICI Bank, Axis Bank and SBI that are well capitalized and have strong liability franchise, which translates into lower cost of funding and trading at relatively cheap valuations. Thank you so much again for tuning in at Dream Ladder Capital. If you like the video, please like, share and subscribe. And yes, leave a comment on what your take is and what would you like to hear next from us.